Assalamualaikum warahmatullahi wabarakatuh. My name is Mohamad Aliff Shahbirin bin Ruba'ai, and our group represent about Clientele Effects. So, what is Clientele Effects? Clientele Effects is a theory which states that different policies attract different types of investors, and changes to the policies will cause a shift in demand for the company's stock by investors, impacting its share price. In other words, the clientele effects is the existence of groups of investors who are attracted to investing in companies with specific policies. So now, let's move to the understanding of the clientele effects. So, the clientele effects can be easily explained in the context of the company's dividend policy. The primary types of investors or clientele that these effects applies to in the real world are known as the dividend clientele. These are the investors whose foremost goal in investing in a company's stock is to earn a regular substantial income from the dividend payout by the company. So, consider that a company makes changes to its policies that reduce the dividend rate or the final dividend amount received by its investor. In such a case, the dividend clientele of the company will be impacted and the stocks will no longer meet the goals of these investors. This can result in this clientele selling off their shares in the company in order to invest in a company that offers higher dividends. As a result, the clientele effect will directly impact the company's stock and their price movements.
Apart from the dividend, clientele also focus on the goal of income generation. However, there are also investors who invest in a company with different goals in mind. One such goal could be reinvest in the business growth of the company. Instead of keeping the dividend, such growth investor might prefer to retain their earnings and direct them back into the company. Hence, if a company policies aim to reinvest its profit back to its growth, it might draw some clientele to invest in the company's stock. Hence, the clientele effect also applies to this subset of investors. Looking at institutional investors such as mutual funds, insurance company, family offices, bank, and etc., some may be limited to only being able to invest in a company that pay a sizable dividend. Furthermore, the mandate of each institutional investor are different, resulting in a unique list of permissible investment. All of the consideration above suggest that the clientele effect does exist. When a company changes its policy significantly, it can cause a shift in the clientele of the company. Thus, it will affecting its share price.
Assalamualaikum warahmatullahi wabarakatuh. My name is Yusuf Faris. Now I will explain about the example of clientele effect. For example 1, investors seeking a reliable sources of income are attracted to stock with relatively high dividend yield. If a company that pays out a high percentage of earnings in the form of dividend were to suddenly lower their dividend payout ratio, this same investor may decide to sell their shares of stock since it's no longer aligned with their investment objective or goals. The clientele effect will explain the lower price of the company common stock as this former shareholder reduced the overall demand for these securities. For example 2, a retired investor looking for stable dividends for likely choose to divest share held in a company that announced a significant cut to their dividend payout. Once a company has established a set of policies, whether it be their dividend policies or environmental, social, and corporate governance policy, the clientele effect outlines the importance of refraining from making dramatic changes to such policies to prevent a shift in clientele, which may negatively impact the company's share price. For example 3, Company A is a high-growth company that has developed leading-edge technology. It will invest all earnings back into the company. In recent quarters, the adoption of the company technology in key countries has slowed due to the number of the new entrants. The CEO of the company has decided to focus on solidifying its current market share rather than aggressively expand. As such, the company now has earnings that do not need to entirely reinvest into the company. Company A subsequently announced a constant dividend policy. Following the news, the stock sees heavy sell and a significant drop on its share price. As an equity analyst of company A, what initial comment can we make regarding the rationale for its share price drop? It is expected that the clientele of company A are investors looking for stock with high growth potential and share price appreciation. Note by the company, they have decided to focus on maintaining rather than expanding its current market share and have installed a new dividend policy. As a result, the clientele of company A that have preferred capital appreciation has likely moved on, attribute to the clientele effect causing the share price to drop.
Next, I will be discussed about the case study regarding Binti stores. The market closed on September 25th, 2001. Binti store, which is a supermarket chain in Jacksonville, Florida, announced that it will cut its annual dividend to $1.02. The firm's policy had been to declare 3 monthly dividend payment of 8.5 cents per share at the beginning of each quarter. This dividend policy had attracted a clientele of investors who valued the regular current income. Under the new plan, the company would declare a quarterly dividend of 5 cents and eliminate the monthly dividend. At that time, Binti was the only one remaining companies of the New York Stock Exchange to pay the monthly dividend. Simultaneously, Binti lowered its fiscal 2002 earning estimate, indicating that first quarter earnings would range between 15 to 18 cents per share, instead of the projected 24 to 30 cents per share. Following the news, Binti shareholders saw the value of their share plummet. During next day trading, Binti common stock was only 37% decline on very heavy volume. After all, Binti's CFO said that the new dividend policy would offer the company greater financial flexibility, as it was altering its strategy to emphasize capital appreciation instead of cash payment to stockholders. At the end of this case study, we can clearly see that the stock price decline sent the message that existing shareholders did not appreciate about Binti's new policies and emphasize.
So, in the conclusion, the clientele effect is an essential theory to keep in mind before investing in the stock market. Apart from the stocks, however, the theory also applies to a variety of securities and financial markets. This is because the goals and demands of investors will always determine their choice of investments. As a result, policy changes by any company will affect the interest generated or lost in its investments and therefore have a direct impact on its price movements. So that's the end of our presentation. Thanks for watching and Assalamualaikum.